Market structure. It can play a key role in the ebb and flow of liquidity and can really influence price action. But it can also offer us a heightened understanding to help us understand reversal points in markets, identify trends, and assess our trading environment as well. And this video is designed to give us a good understanding as you build your trading process. So take it away, Ty and Tom.
All right, welcome everybody. What we'll be covering today is of how you may have been looking at markets wrong if you've been scalping, day trading, or even swing trading without this technique. So markets often look a little bit messy. You know, theory is very different to, I guess, the practical application. It's kind of like when you go to university, Ty, and you learn a lot, and then you come out into the workforce and you're like, what am I doing? And everyone's like, oh, you're that newbie that has all the theory but doesn't know the understanding just yet. We've all been there.
One. Yep.
Yeah. Yeah, the left-handed screwdriver, exactly. So that brings us to a topic that is near and dear to our hearts, which is how does market structure actually work? You know, what is it when we're looking at markets and we're looking at naked chart analysis? How do we understand the squiggly lines on the screen in a better form? So if it looks something like this, how do we interpret something like that? Well, today we discuss market equilibrium, the laws of supply and demand, and then, of course, using naked charts to recognize those areas of equilibrium. So first up, I want to discuss the idea of supply and demand. Now, everybody probably is aware of supply and demand, but do they know why it works and why it actually forms? So Ty, how important is it to understand these particular concepts of supply and demand? I mean, it only happens when basically big players play the game, isn't it? We're small fish. We can't push the markets like these guys can.
Absolutely, and this is why it's vitally important to understand these zones. And look, changes in supply and demand only happen when the big traders buy or sell. When price falls, we're going to see a different form of market, and when price rises, of course, it's going to be the same. We have not caused that, and I think it's very, very important to understand that. We are not, as retail traders, which the majority I can imagine will be, are not causing the markets to rise or fall. It is the big players that are doing that. So when price falls, supply outweighs demand. Retail traders are the small fish, like we said, so we cannot make the prices rise or fall. And I think a lot of people, we probably realize that. I think at the start, we don't when we first start out trading, but I think in time, when you do trade for a little while, you do realize that we're not actually making the markets move. So it's really straightforward like that. In Forex, commodities and stock markets, I was actually underreading that screen. It's really the same. What we're saying is the big banks and institutions can never place their full position, so they are going to place small amounts of movement. Sometimes we look at that and we say they're market traps, or we call them bear traps or bull traps, or false breakouts. Look, sometimes you can fall into that trap if you don't really know what you're looking at in these particular zones. You can certainly find yourself falling into those traps. Are they set for the retail traders? Well, perhaps, but all we're doing really by falling into these traps is really highlighting the levels that they're buying at. Don't forget, they're not buying at one price; they're buying at a series of prices. And what we consider traps are those prices actually falling into those places.
So when we're understanding supply demand, it looks something like this on charts. Often you'll see charts being drawn where we've got trend ups or markups, and then we have distribution events, reaccumulation events, accumulation events, and they really just are demand and supply. An accumulation event is demand once it breaks out and up. It is not known as demand until we see that breakout of the upward side. For a supply, it takes the market to break down for us to know that that was distribution or a supply event. And because we know that there is market orders at these levels, what we can do is we can figure out that these are market equilibrium points. And this brings us to a very important topic of supply and demand. We need to know where market equilibrium points are so that we can potentially trade off those in the future. Take this example, for instance. If we look at this example here and we look at the left-hand side, what you'll notice is that there is a lot of market structure that leads into a huge breakout, and then there's an obvious market structure here, and then that leads into another massive breakout. When the price comes back down to this level, what happens? Well, price is met by buyers. And in essence, this whole area here is actually incredible demand. And what that leads into is buying, and then eventually the trend actually continues on. And this is what we call basically a rally, a base, and a rally. And when the market comes back down to these base levels, we're interested in potentially looking at opportunities. Whether you're a day trader, you're a scalper, or you're a swing trader, these areas can be incredibly important. And that's because they're returning back to market equilibrium. So this is a very, very important aspect of markets. Also, we know about the fact that we've got supply up on the top-hand side. The markets have sold this level before. So therefore, if the market comes back to this level, we can guess that there's probably going to be sellers around this zone. Another important aspect of it. So, of course, supply zones are the backwards version of demand. Basically, they represent points where banks and instos have placed significant numbers of sell positions instead of buy positions, and they end up creating excess supply, and the result is prices reverse and move lower. They're effectively like the resistance level of supply and demand, and you'll see some overlap often between supply and demand zones and resistance support zones. So if you're somebody that comes from that backing of understanding support and resistance, then this is really kind of like a nuanced way of doing it. And what you're trying to understand is market equilibrium. So very important to understand both supply and demand. But then when we're in the charts and when we're in the actual market action itself, how are we going to better understand where we might want to actually be placing? Well, here's an example of a drop, a base, a drop, and then a return back to the supply tie.
Yeah,
This is pretty much one of the biggest trades, isn't it?
It is, absolutely. And look, I think you bring up a really good point where, when a market is in equilibrium, this is exactly why not knowing whether it's actually supply or a demand zone before it actually breaks out is the very reason why we don't try to preempt what the market's going to do until it actually does it. And it goes a long way to say why patience is so important in trading, because realistically, we can see the market bouncing between levels of highs and lows, but we don't really know which way it's going to break. And a lot of people make the mistake of trying to identify a break before it happens and thinking, well, the market must go up or the market must go down. We don't really know whether it's actually a supply zone or a demand zone until it actually breaks in that particular direction. And this is where you really don't want to just be trying to preempt or guess the direction because you have a gut feel. The market action is what you really want to see. And then when it is identified, it makes a trade like this that we can see on the screen very, very simple, because once that supply zone has broken down and it retests it from below, as you can see here, a lot of people, if you didn't know the supply zone was there and you weren't aware of what has happened on the left of the chart, you may be tricked into thinking that this market's going to go long and we're looking to go to brand new highs. But in reality, this is one of the places that we're looking to sell, because this has already been identified as an area of very high transaction. So it's really telling us what we need to know, but probably highlights the fact that, you've got to look to the left of the chart, don't you, Tom?
You always must look at the left. We're looking at we try to find equilibrium zones, and we understand that when markets return back to those equilibrium zones, or in this case supply, there are orders that were placed there that led to a sell-off. So why would you not believe that there is large institutions that are going to be excited around these levels, Tyrone? And this is the thing. It's about understanding that institutions placed orders there before that led to a certain action, the effect, and therefore if the markets go back to those levels, we could be very confident that there is probably going to be some action around those zones. And you can see how it differs from standard support resistance theory. That would be that this is support, and then the market breaks the support. And if it comes back, you'd be looking at this zone here being the resistance. So therefore, you'd be looking at selling this zone. While it did sell from that level, you'll notice that the biggest sell comes off this area up here, which is where the market's placed the vast majority of the orders. And that's why we also want to be understanding volume, equilibrium, and some of these points here. Now, which are the best trading pairs for supply-demand theories? Well, in general, we want to be looking at highly liquid pairs, Tyrone, and it's always going to be the biggest pairs that retail traders generally trade. Why? Because in essence, with supply-demand theory and in Wyckoff theory and everything like that, we are really taking advantage of manipulation of markets that tend to trap us.
Yes,
and
absolutely.
that's what we want to be doing. We want to be reacting to those manipulations.
Yeah, you do. Look, low liquidity markets can be very, very problematic when you're trying to set up any sort of plan, whether it's technical analysis, whether it's fundamental analysis. Very low liquidity can be very, very problematic. So when you really concentrate on the bigger base pairs, and there's plenty of them too. Like, we're not really limiting how you can trade. There are literally 20 or 30 currency pairs that we would consider fairly liquid, wouldn't we, Tom? And then you've got your major indices. You're never going to run out of things to trade. And then don't forget, with every trading pair or every instrument that you're trading, there are different time frames that you can do. So if it's not really moving on a daily or a 4-hour or an 8-hour, you can go down to a 1 hour and actually see these setups happening. So it really comes down to how you want to place your trades. But you're not going to be limited by focusing on high liquidity. And remember, though, that low liquidity can be very, very problematic. And a lot of people want to try and get an edge, and I can understand that. But realistically, sticking with the bigger ones is going to give you the most amount of movement and the most amount of reliability, I think.
Okay, so what time frame is best for you when thinking about supply and demand theories? The question really comes down to what type of market you're trading and also where you're from in the world. Generally speaking, the best session for currencies would be the London pre-open and then into the US overlap. For something like gold, potentially the Asian session and the London Open can be very good. For somebody that wants to trade indices, usually the US session is incredibly powerful. So it really comes down to what type of instrument do you want to select. And then more importantly, we then need to understand that trading around the opens is going to be the largest chance of a false move and therefore a trap being set that will often go off in the other direction. So next time you're looking at a market and it goes one way and then it goes opposite straight after that, what that is it's a liquidity trap. And actually, it's in essence generally a market coming back to a level of equilibrium.